Folks, if you had spent a career in finance, working at one of the most prestigious banks, at one of the best money management firms around, even done a stint at the IMF, and you decided to set up a research institute at the LSE to examine the industry that made you your fortune, you probably would not call it the Center for the Study of Capital Market Dysfunctionality. But that is exactly what Paul Woolley did. He did work at the IMF. He was an executive director at Barings, and he ran the London office of Grantham Mayo Van Otterloo. And he has some serious concerns about the business of finance. Paul is in our London bureau this morning. Paul, it has been almost 4 years since the beginning of the subprime crisis, which of course led to the financial crisis and the global economic crisis. 4 years. What have we learned? If you look at the financial markets around you, would you say that they are any more of a safer or perhaps less dysfunctional place than they were back then?
I think we're in very dangerous territory. The finance sector has grown over the last 20 years to the point where it is the largest global industry. It is inherently unstable. Unfortunately, competition and free markets don't work in finance as they work in other industries. It's caused the finance sector to become too large and unstable, to misallocate resources, and I do worry that we're back in the situation of low interest rates that could fuel other bubbles.
Now, low interest rates and what else? What is it ultimately that brings the system to the brink of collapse? If competition doesn't make finance more efficient, doesn't bring down prices, what ultimately takes us to the brink?
There's an inherent instability because unfortunately we're in a situation when the giant investing funds like the pension funds, the charitable foundations, college endowments, the sovereign wealth funds, they delegate management of their assets to managers. The managers are constrained by the contracts that are given to them by these large investors, and there's an inherent instability in that. It means that the whole focus on investment has become short-termist rather than long-term as it should be, and the short-termism is the root of the instability. It causes the bubbles and crashes which we've experienced over the last 10 years.
We are back now with Paul Woolley, the former banker who started the Woolley Center for the Study of Capital Market Dysfunctionality at the London School of Economics. Paul is also a former advisor to the House of Lords Committee and was an economist at the IMF. Paul, you have spent a lot of time studying rents. And what I mean by rents aren't the things that people are charged in apartments. They are the fees that bankers charge clients for what economists say are services of little to no value. Are you seeing any signs, given that we've heard many bankers, CEOs say, we've learned our lessons from the financial crisis, we're no longer providing short-term incentives to our traders? Are you seeing any evidence that people are not charging rents the way they used to?
Rents are excess profits. I mean, it's perfectly fine to charge a fee for a service. And in a competitive environment, those fees will be normal sorts of returns for the agents providing the service. But rents are excess profits, and they're earned in large measure because of the structure of performance fees in particular. Short-term performance fees mean that, for instance, the hedge funds, they gain when they gain substantially when they're up in terms of performance, and when they're down, the client suffers. So it's the asymmetric return profile that causes is a large reason for these excess rents.
So do you see, Paul, any evidence though that rents are still being charged the way that they have been, or perhaps being charged even more so in this day and age?
No, it's a natural outcome of the financial markets, the way they work. It really is a situation where the agents end up capturing most of the gains and the customer just gets a sort of basic return. However good, and indeed the better the hedge fund, for instance, the better the asset manager, the more chance is that he will get the lion's share of any excess return and suffer no penalty. It's intrinsic in the way the contracts are drawn. What you have to do is you can reduce rents by rewriting the contracts in ways, for instance, the performance fees are only paid on a 3 or a 5 year basis. And indeed, I don't think that, I mean, performance fees encourage short-termism, they encourage momentum trading, and there's no change at all in what we've seen before the crash and now after. We're just on the same track as we were going into the crash in 06-07.
Paul, I want to pick up on your point about momentum trading, because we see a great deal of what some might call herding, for example, or what in market parlance is more like the crowded trade, whether it's Apple computer stock, or it's only called Apple these days, or whether it's the dollar right now with all this risk aversion spurred by Korea, or everything perhaps that's going on in commodities. What are the risks in herding?
Herding, it's a term that it sounds pejorative. There's quite a lot of momentum trading that is actually just a natural outcome of being benchmarked against an index. Managers seek to keep their performance within certain bounds, certain distance away from the index, and that actually causes them to buy stocks that are going up even if they think they're poor value. Herding, really, the bulk of investment these days has a short-term emphasis and implies momentum, and that's evident in the equity markets, currency markets, and we're seeing it now in commodity markets, which is very dangerous. I think, in fact, the commodity markets, the way the large investors have moved in the last 3 or 4 years into commodities, is storing up a great potential landmine.
Paul, we thank you for joining us here on the Inside Track and would love to have you back. Paul Woolley of the Woolley Center for the Study of Capital Market Dysfunctionality at the London School of Economics.